Hey everyone, my name is Alex and I am a lead consultant with Expat Exact, an expatriate and relocation agency dedicated to helping you find the destination that matches your destiny. Today, we're diving into a topic that comes up in almost every single conversation I have with clients who are considering a move abroad, and that is banking internationally. Specifically, we're going to answer the question that keeps a lot of people up at night. How do you actually know your money is safe when it's sitting in a bank in another country? This is Banking Internationally 101. And by the end of this video, you're going to have a clear, practical framework for evaluating any bank in any country before you ever wire a single dollar overseas. No fluff, no vague advice, just real tools that real professionals use. So let's get into it. When you bank in the United States, you probably don't spend a lot of time worrying about whether your money is safe. You deposit it, you use your debit card, you check your balance on an app, and that's pretty much it. The reason you sleep well at night is because there's an entire infrastructure or at least learned trust built around protecting your deposits. Regulations, oversight bodies, insurance schemes, and most of us have never had to think twice about it. The moment you move abroad or even consider opening a bank account in another country, that invisible infrastructure changes. Sometimes it's stronger than you'd expect, sometimes it's virtually non existent. And the scary part is that most people have no idea which situation they're walking into until something goes wrong. I've spoken with clients who've moved to beautiful countries, opened up accounts at banks that looked perfectly professional, had a nice lobby, a mobile app, a friendly customer service team, and then years later found themselves in a financial hiccup because the country's banking system was undercapitalized, poorly regulated, or simply not set up to protect foreign depositors the way they assumed it was. So, this video exists because we don't want that to be your story. Before we get into specific tools and resources, we need to align on what we mean when we say a bank is safe, because this word gets used a lot and it actually covers several different things. First, there's solvency, meaning the bank has enough assets to cover its liabilities. A solvent bank isn't going to collapse tomorrow because it lends out more money than it can recover. Second, there's liquidity, meaning the bank can actually give you your money when you ask for it. A bank can technically be solvent but still face a liquidity crisis if too many people try to withdraw funds at the same time. We saw this play out in real time during various banking panics throughout history, and it still happens today. Third, there's regulatory protection, meaning that even if something does go wrong, there's a system in place to make you whole, or at least up to a certain limit. This is where deposit insurance comes in, and we're going to spend a lot of time here because it's one of the most misunderstood areas of international banking. And fourth, there's legal and political risk, meaning the stability of the country itself, its legal system, and whether a foreign national like you actually has enforceable rights if a dispute arises. When I say, is my money safe? I'm really asking about all four of these things simultaneously. And the good news is there are specific publicly available resources that let you assess each one. Let's walk through them. Variable one, deposit insurance coverage. Let's start with the most fundamental protection most people are familiar with. Deposit insurance. In the United States, the Federal Deposit Insurance Corporation, the FDIC, insures up to $250,000 per depositor, per institution, per ownership category. That's a meaningful backstop. If your bank fails, the federal government steps in and makes you whole up to that limit. Now, here's where it gets complicated internationally. Not every country has this. And among those that do, the limits and structures vary enormously. In the European Union, there is a harmonized deposit guarantee scheme that covers up to 100,000 euros per depositor per credit institution. So if you're banking in Spain, Portugal, France, Germany, Ireland, any EU member state, you have that baseline protection. That's actually a pretty robust system. It gives a lot of our clients real peace of mind when they're relocating within Europe. But step outside the EU and things may change. Panama, which is one of the most popular relocation destinations for Americans and one we work with extensively at Expat Exact, does not have a national deposit insurance scheme for most retail bank accounts. There is a bank resolution framework, and some banks hold private insurance or are branches of international institutions that carry their parent company's protections, but there is no government backed if the bank fails, here's your money back guarantee the way that the FDIC works in the US. That doesn't mean banking in Panama is inherently unsafe. Many of the banks there are very well capitalized and conservatively managed, but it does mean you are taking on a different risk profile than you would be in the US or the EU. Uruguay has a deposit insurance fund, but the coverage limits are relatively modest. Costa Rica has a scheme, but it primarily covers state banks. Mexico has IPAB, which covers roughly up to 400,000 UDIs, which is roughly equivalent to around 25,000 US dollars per depositor. Thailand, Vietnam, and much of Southeast Asia have government guarantee schemes, but again, the limits are typically much lower than what Americans are used to. The takeaway here is simple but important. Before you open a bank account abroad, find out whether the country has a deposit guarantee scheme, what it covers, and whether you, as a foreign national, are even eligible to claim it. The last part surprises a lot of people. Some countries' guarantee schemes have limitations on coverage for non residents. The next tool in your toolkit is bank credit ratings. And this is where you start to look at the individual institution rather than just the country level protections. You've probably heard of Fitch, Moody's, and Standard and Poor's, and the three major global credit rating agencies. What you may not know is that these agencies don't just rate governments and corporations, they also rate individual banks, and those ratings tell you a tremendous amount about a bank's financial health, its management quality, its capitalization levels, and its resilience under stress. The rating scales vary slightly by agency, but they all follow a similar logic. At the top end, you have investment grade ratings, AAA, AA, A, triple B in S&P terminology, which indicates strong institutions with low probability of default. As you move down the scale towards double B, B, triple C, and below, you're entering speculative or high yield territory, meaning the institution carries significantly more risk. When you're evaluating a bank abroad, the first thing I'd recommend is simply searching that bank's name alongside the words credit rating plus the name of one of those agencies. In many cases, particularly for large international banks, you'll find publicly available rating summaries. Fitch, in particular, often publishes abbreviated rating reports that are accessible without a subscription. Now, a word of caution, not every bank in every country is rated by the major agencies. A small community bank in a developing economy almost certainly won't have a Moody's rating. In those cases, you need to rely on other signals, which is exactly why we're covering multiple variables here. For professionals and institutional investors, there's a more powerful tool called BankScope, which is now called Orbis Bank Focus, published by Bureau van Dijk. This is a comprehensive global database of bank financial statements, ratings, and performance metrics. It's used by bank analysts, regulators, and financial institutions around the world. Individual access can be expensive, but some university libraries provide access, and a financial advisor who specializes in international clients may be able to pull data from it on your behalf. The bottom line on ratings: if you're planning to keep a significant amount of money in a foreign bank, you want to know whether that institution has been independently assessed and what that assessment found. Now we're getting into the country level macro analysis, and this is a resource that very few individual expats know about, but it's an extraordinarily valuable one. The International Monetary Fund, the IMF, conducts what are called financial sector assessment programs, or FSAPs. These are in depth evaluations of a country's entire financial system. They assess things like the strength of bank supervision, the quality of regulatory frameworks, whether the central bank has adequate tools to manage a crisis, the capitalization levels of the banking sector as a whole, and how the country compares to international standards for financial stability. These reports are published on the IMF's website at imf.org, and they're publicly available for free. You can search by country and find the most recent FSAP report, which will give you a remarkably honest and detailed picture of that country's banking system health. What I love about FSAPs is that they don't sugarcoat things because they're produced by an independent international institution. They'll tell you if a country's banking supervision is weak, if the legal framework for resolving failed banks is inadequate, or if there are systemic vulnerabilities that could put depositors at risks. They're written in fairly technical language, but even if you skim to the executive summary and the key findings sections, you'll get meaningful signal about whether you should be comfortable keeping substantial funds in that country's banking system. For example, if you're looking at moving to Portugal and want to understand the health of Portuguese banks as a system, you can pull Portugal's FSAP and see exactly what the IMF found, including any areas of concern, the strength of the deposit guarantee scheme, and how the Bank of Portugal performs as a regulator. This is one of those tools where 10 minutes of reading can save you years of regret. Next up is the BIS, the Bank for International Settlements, which you can find at BIS.org. This is sometimes called the Central Bank of Central Banks because it's the institution where central banks from around the world do business with each other. And it publishes some of the most comprehensive data available on global banking system health. The BIS publishes quarterly banking statistics that track cross border bank flows, capital adequacy ratios across countries, and exposure levels that tell you how interconnected and vulnerable various banking systems are. It also publishes research and working papers on financial stability topics. For the average expat, the BIS might feel a bit academic, and honestly, it is more useful as a macro level signal than as a tool for evaluating a specific bank. But there are a few specific BIS resources worth knowing about. The BIS publishes what's called the Basel III framework, which is the international standard for how much capital banks are required to hold relative to their risk weighted assets. Countries that have adopted Basel III and actually enforce it give you significantly stronger protection than countries that haven't. When you're researching a country's banking environment, checking whether they're a Basel III signatory and whether they actually implement is a meaningful data point. The BIS annual economic report also provides a global overview of banking system resilience and highlights emerging vulnerabilities, which is useful context if you're moving to a region that might be facing macro level financial headwinds. Think of the BIS as your 30,000-foot view of the global banking landscape. It helps you contextualize the country level and institution level research you're doing with everything else we've discussed. This is one that doesn't come up as often in conversations about personal banking safety, but it actually should. And here's why: the Financial Action Task Force, or FATF. It's an intergovernmental body that sets international standards for combating money laundering, terrorist financing, and related threats to the integrity of the global financial system. You can find them at fatf-gafi.org. FATF maintains two critical lists that every international banker and expat should know about. The first is what's commonly called the gray list, officially the list of jurisdictions under increased monitoring. These are countries that have committed to working with the FATF to address strategic deficiencies in their anti money laundering frameworks, but haven't yet completed the necessary reforms. The second is the blacklist, officially the list of high risk jurisdictions subject to a call for action. These are countries with serious systemic deficiencies and where FATF recommends enhanced due diligence for financial transactions. Why does this matter for your personal banking safety? A few reasons. First, if a country is on the FATF gray list or blacklist, it signals that the government either can't or hasn't been willing to maintain basic standards of financial integrity and oversight. That same lack of oversight that allows money laundering to flourish also tends to correlate with weaker protection for ordinary depositors. Second, being on the FATF gray or blacklist has real practical consequences. International banks and correspondent banking networks start pulling back from those countries. Wire transfers become harder, slower, or more expensive. In some cases, major banks will stop maintaining correspondent relationships with banks in gray listed countries entirely, which means your ability to move money in and out of the country can become severely restricted. We've seen this play out in real time with clients who opened accounts in countries that subsequently got gray listed. Suddenly, transactions that used to take 2 days were taking 2 weeks. Fees skyrocketed, and in some cases, accounts were effectively frozen for compliance reviews. It's a serious operational risk that people don't think about when they're looking at interest rates and account minimums. Third, and this is particularly relevant for Americans because FATF's interaction with US regulatory frameworks, banks in gray listed countries may face additional scrutiny from FinCEN, the Financial Crimes Enforcement Network, which is the US Treasury Bureau that monitors international financial flows. That scrutiny can trickle down to affect your personal accounts and reporting obligations. The good news is that the FATF lists are completely public and updated regularly. Checking whether a country is on either list takes about 60 seconds and should be an absolute baseline check before you open any international account. So let's pull everything together into a practical checklist you can actually use. When you're evaluating banking in a new country, you want to work through these 5 questions in order, starting with the FATF. Is the country on the gray list or the black list? If yes, that's a major red flag, and you need to understand the implications before going any further. This is your first filter. Next, look at deposit insurance. Does the country have a government backed deposit guarantee scheme? What are the coverage limits? Are foreign nationals and non residents covered? Compare those limits to the amount of money you're planning to hold in country and decide whether you're comfortable with that exposure above those limits. Then look at the IMF FSAP for that country. Pull up the most recent report at imf.org. Read the executive summary and key findings. Are there identified systemic vulnerabilities? Is bank supervision described as strong or weak? Are the concerns about capital adequacy or crisis resolution frameworks? From there, check the BIS data. Is the country a Basel III signatory and do they actually enforce it? Are there any macro level concerns about the country's banking sector in recent BIS reports or working papers? Finally, look at the specific bank you're considering. Does it have a credit rating from Fitch, Moody's, or S&P? If it does, is it investment grade? If it doesn't have a rating, that's not automatically disqualifying, but it does mean you need to rely more heavily on the country level factors and potentially seek out a local financial advisor who can give you institution specific intelligence. Beyond the 5 variables we've covered, there are a few additional practices that I recommend to every client who is banking internationally. Don't put everything in one place. This might sound obvious, but the temptation when you move abroad is to consolidate everything into your new local bank for convenience. Resist that temptation. Keep a US account active or wherever your home country account is and maintain meaningful liquidity there. If your overseas bank faces any kind of disruption, you want to have funds you can access immediately without going through that banking system. Understand the currency risk separately from the banking risk. Even if your bank is perfectly safe, if it holds your money in the local currency and that currency devalues significantly, your purchasing power suffers. These are two different types of risks and they require two different types of analysis. Know your FBAR and the FATCA obligations as an American. If you're a US citizen or permanent resident and you have foreign bank accounts with aggregate balances exceeding $10,000 at any point during the year, you are required to file an FBAR, a foreign bank account report with FinCEN. FATCA adds additional reporting requirements for higher balance thresholds. These aren't banking safety issues per se, but failing to comply creates a different kind of risk, legal and financial penalties from the IRS that can absolutely disrupt your financial life. Always work with a tax professional who specializes in expat taxation. And finally, when in doubt, use a branch of an international bank rather than a local institution. If a global bank like HSBC, Citibank, Standard Chartered, or Scotiabank operates in the country you're moving to, banking with that institution typically means you benefit from the parent company's capitalization, its international regulatory compliance standards, and an established global infrastructure for resolving problems. It's not foolproof. Local subsidiaries can still face local regulatory issues, but it is generally a more resilient starting point than a purely domestic bank in a country that you don't know well yet. Here's what I want you to take away. Banking internationally is not inherently dangerous. In fact, some of the world's most stable and well regulated banking systems are outside of the United States, but it does require active due diligence that most people simply don't do because they assume that if a bank has a nice building and a mobile app, it must be safe. The five variables we covered to date: deposit insurance schemes, bank credit ratings, IMF FSAPs, BIS data, and FATF lifts give you a comprehensive layered framework for evaluating bank safety anywhere in the world. These are not obscure tools. They're public, they're free, and they're used by the world's most sophisticated financial institutions to make exactly the kinds of assessments you need to make. At Expat Exact, this is the kind of guidance we walk our clients through as part of every relocation engagement. Where you bank abroad is not a minor logistical detail. It's a foundational financial decision that affects everything from your day to day access to money to your long term asset protection to your legal compliance as an American living overseas. If you found this video helpful, please subscribe and hit the notification bell so you're receiving everything you need to know about making an informed, confident move abroad. And if you're actively planning a relocation and you want personalized guidance, visit us at expatexact.com. We'd love to help you find the destination that matches your destiny.